Imagine owning a massive estate. I'm talking about a mansion that just keeps getting bigger. You're adding new wings, you're upgrading the foundation, putting in all this state-of-the-art tech. The value of this place just skyrockets to over $500 billion Turkish lira.
So you're rich on paper. It's a classic liquidity versus asset value paradox.
Totally. But then you look at your checking account at the end of the year, and instead of a mountain of cash, you see, well, pocket change.
You are rich, but cash poor in the moment.
And that is the ultimate puzzle for the retail investor right now. We're looking at a company today that grew its assets to a staggering 558 billion lira in 2025.
And yet
Its net profit took a nosedive. We're talking over 95% compared to the year before. How does a giant get so big but report earnings that look so microscopic?
it creates a serious cognitive dissonance. But when you start to peel back the layers of these financial statements, the logic does reveal itself.
So it's not a sinking ship.
No, not at all. It's more like a ship in dry dock for a massive, massive refit.
Welcome.
It's good to be here to unpack this.
Today, we are tackling the heavy lifter of Turkish industry, Erdemir Fabrikaları, or, as everyone knows it, Erdemir.
We're diving into their consolidated financial statements and also the independent auditor's report for the period ending December 31st, 2025.
And our mission really is to strip away all the jargon.
Absolutely. To decode these dense tables for the everyday investor and see if the fundamentals actually hold up against that really scary profit drop.
Let's first get to know the company a little, because for a lot of people, Erdemir is just a ticker symbol, ERGL. But physically, what are we talking about here?
We are talking about an industrial empire. I mean, it was founded back in 1960, headquartered in Ataşehir, Istanbul.
But it's not just one factory.
Oh, no. It's a sprawling network that basically controls the entire steel life cycle.
The whole chain.
Pretty much. You have the main Erdemir plant, which is massive. Then you have Erdemir in Iskenderun, and they own almost 95% of that. That's their integrated steel powerhouse.
And it goes deeper than that.
Right. It does. They have Amadin, which handles the mining operations.
And that's a huge strategic advantage. It's like the difference between buying dinner out versus, growing your own vegetables.
That's a great analogy. By controlling the raw materials, the iron ore, through Amadin, they insulate themselves from a lot of the supply chain shocks that can kill their competitors.
What else is in the empire?
Well, there's Ursum for steel services, Erdemir Romania for production over in Europe, and even Erdemir Asia Pacific in Singapore for trading.
I noticed they're branching out too. Erdemir Energy caught my eye.
That's their play on renewable energy. We can touch on this later, but the whole steel industry is under immense pressure to go green.
So Erdemir Energy is their answer to that.
It is. It's their answer to future demand.
It's a massive web, and keeping it running takes a small army, I see. The report says their workforce hit 12,824 people in 2025.
Yeah, that's up from about 12,600 the year before, and the breakdown is telling.
How so?
You've got roughly 8,900 hourly wage workers, the people actually sweating near the blast furnaces, and about 3,900 on monthly salary. It's a heavy, labor-intensive operation.
Now, who is steering this giant ship? The ownership structure is always a big question.
It is. The immediate parent company is Terra Holding, with just under a 50% stake. But the ultimate parent,
The power behind the throne.
exactly, is OYAK, the Turkish Army Pension Fund.
Which always implies a certain level of stability, right? A pension fund isn't likely to just strip the assets and run.
That's the thinking. But there's still a lot of room for the public. About 47% of the company is publicly traded. That's the free float.
Okay, and what about the board?
9 members, 3 of whom are independent. It's a pretty standard setup to protect minority shareholders.
Speaking of the top brass, a number jumped out at me. The compensation for top management? The board and key execs?
You noticed that hike.
Hard to miss. In 2024, they were paid 147 million TL. In 2025, that jumped to 236.5 million. That's a pretty big increase.
It is a steep jump, well above the official inflation rate, in percentage terms.
So does that sit right with you? In a year where profits just completely tanked?
Well, it's a friction point. Shareholders are usually fine with high executive pay when dividends are flowing and the stock is soaring.
But when the bottom line thins out,
People start looking at those numbers with a magnifying glass. To be fair, though, from a management perspective, running a company this size in this economy is incredibly complex. Talent retention is expensive.
okay, fair enough. Let's do a quick SWOT analysis before we get into the profit numbers. Strengths, weaknesses, give it to me in a nutshell.
Okay, strength. Massive asset base and that vertical integration with the mines. They really control their own destiny.
And this is it.
They are incredibly sensitive to global commodity prices. Steel prices drop, coal prices spike. They feel it immediately. And then there's the currency issue.
Ah, right. The functional currency.
It's a major complexity. They operate in US dollars, but they have to report in Turkish lira.
So the numbers can swing wildly just because of the exchange rate, no matter how much steel they actually sold.
Precisely. As for opportunities,
The green transition.
that's the big one. Their investment in Erdemir Energy modernizing the plants, they're pivoting toward greener steel. If they crack that, they win the next decade.
And threats.
Inflationary pressures on costs, and as we're about to see, some very big tax liabilities.
All right. The stage is set. We know the players. We know the stakes.
So now we can move on to our analysis.
Let's open the books.
Let's do it.
I want to start with the number that I think gave every single investor a heart attack. The net profit.
Okay.
In 2024, the parent's share of net profit was, what, around 13.5 billion lira?
Roughly, yes, 13.48 billion.
And in 2025, it's 511.8 million TL.
That is a drop of roughly 96%.
96%. I mean, if I'm a shareholder, I'm panicking,
Yeah.
thinking, did they just stop selling steel? Did the factories burn down? What happened?
And that's exactly why you can't just read the headline. First, you have to look at the revenue. Okay.
Revenue for 2025 was 208.9 billion lira.
So they are still generating massive sales. The money is coming in the front door.
Correct. The operational engine is running just fine. They're moving metal. The issue wasn't sales. The issue, the real elephant in the room, is sitting in Note 32 of the financial statements.
Note 32. Okay, what's hiding in there?
Deferred tax expenses. If you look at the tax line, they booked a massive liability. The deferred tax expense was over 19.2 billion lira.
Wait. 19 billion lira in tax expense?
Yeah.
That basically ate the entire operating profit. Why so high?
This gets a bit technical, but it's often an accounting adjustment based on revaluing assets in high inflation environments. The value of your factories goes up in nominal lira terms.
And the tax authority eventually wants a cut of that.
Exactly. But here's the key thing.
Did they actually write a check for 19 billion lira to the government?
No, not on that day. It's an accounting recognition of a future obligation. It crushes the net profit figure on paper for the year, but it doesn't mean 19 billion in cash just walked out the door. So it's a paper hit, mostly.
In many ways, yes. But for earnings per share, the EPS, it is devastating. It dropped from about 2 lira in 2024 to just 0.076 lira in 2025.
7 kurus.
11 kurus per share.
All right, hold that thought on dividends. I want to talk about where the money is going. I called this the construction zone earlier.
And that is a perfect metaphor. If you look at the assets, total assets grew from 425 billion to over 558 billion lira. That's huge.
So the house isn't crumbling, they're just building a massive new wing.
Precisely. Check out Note 14, Construction in Progress. They have 59.7 billion lira sitting in unfinished investments.
Nearly 60 billion lira in projects that aren't even turned on yet.
Correct. This is a heavy investment cycle. Modernizing furnaces, updating mills, preparing for that green steel future.
Which explains why the auditor flagged it.
Yes, EY flagged tangible assets and investments as a key audit matter. It's the biggest thing happening on the balance sheet. They're sacrificing profit today for capacity tomorrow.
That's the long-term play.
It is. If they didn't spend this money, profit might look higher today, but their factories would be obsolete in 5 years.
Okay, so how are they paying for all this? Usually, big spending means big debt.
And this is where the plot twist comes in. You'd expect, with low profit and high spending, the debt ratios would be awful.
But they're not.
Look at Note 36. Total borrowings, 158 billion lira. It's a big number. But look at the net debt-to-equity ratio. In 2024, it was 27%. In 2025, it dropped to 14%.
Wait, their profit tanked, they're spending billions, but their debt ratio got better. How is that possible?
Because their equity, the value of the company owned by shareholders, grew even faster than the debt. Total equity hit nearly 300 billion lira.
Where did that equity come from if they didn't make a profit?
Inflation and currency. Remember, they operate in USD but report in lira.
Ah, right. So because they own real hard assets, big steel factories, those assets are worth more liras today just because the lira is worth less.
Yeah, exactly. In the equity table, under Other Comprehensive Income, there's a line for foreign currency translation differences. It contributed a massive 51.1 billion lira to equity.
So it's not cash profit, but it is a real increase in the company's value on paper.
Yes. The balance sheet is a fortress, even if the income statement looks like a disaster zone.
That's the perfect way to summarize it. Asset-rich and deleveraging relative to their size.
That's it.
Okay, let's get back to what the retail investor really cares about. Dividends. Erdemir is famous for being a dividend stock in Turkey.
Historically, yes. In 2025, they paid a gross dividend of 0.25 TL per share, which came from 2024's profits.
But dividends are paid out of current profit. We just said the EPS is 7 kurush.
Yeah.
You can't pay a big dividend from 7 kurush of earnings.
It's basic math, isn't it? You can't pay it from earnings if the earnings aren't there. Unless they dip into past reserves, which is possible, a high dividend from 2025's profit is mathematically unlikely.
That is a tough pill to swallow for income investors.
It is. But smart investors know industrial companies are cyclical. You have harvest years and you have planting years. 2025 was a planting year.
A very expensive planting year. Okay, let's touch on the family business aspect, the related party transactions.
Always important with OYAC companies. They do a lot of business with each other.
I see they sold 5.6 billion lira of electricity and steam to a subsidiary.
Iskenderun Energy. And on the flip side, they bought 2.4 billion in services from OYAC Pazarlama and nearly 4.7 billion in logistics from Omsan.
Is that a good thing or a bad thing? You always worry about sweetheart deals.
It's a double-edged sword. On one hand, it guarantees a supply chain. It provides incredible stability.
And the downside.
You're heavily dependent on the group's ecosystem. But generally, for Erdemir, this integration is seen as a net positive.
One more thing from the auditor's report. They also flagged revenue recognition. Why?
Not about fake sales, but about timing. When you ship globally, the question of when a sale is officially done really matters.
Is it when the steel leaves Turkey or when it arrives in Italy?
Exactly. And when you have 200 billion in revenue, getting that wrong by a few days can shift billions from one year to the next.
So, no funny business detected, just a complex machine.
Precisely. The auditor's opinion was clean, what we call unqualified. The numbers are trustworthy.
So, let's zoom out. We have $500 billion in assets, almost no net profit, but huge investments and a great debt ratio. Crisis or construction site?
I'd say it's a transition year. If you only look at the PE ratio, price to earnings, Erdemir will look terrible. The E is almost zero.
It would look like the most expensive stock in the world.
Right. But that's the wrong metric this year. You have to look at price to book, the PB. You're buying a share of that massive asset base.
You're buying the 60 billion lira of investments that are about to come online.
Correct. The balance sheet is a fortress. Assets are up. Net debt ratio is down to 14%. They've weathered the storm.
So the message to the retail investor is patience.
Patience and perspective. Don't panic over the headline profit number. Look deeper. They are refitting the ship to sail for another 50 years.
So here's a provocative thought to leave you with. With 60 billion lira tied up in those unfinished investments, what happens to the stock price when those factories finally turn on the lights? Are you patient enough to wait for the harvest? Or are you scared off by the empty storeroom today?
That is the question that separates the traders from the long-term investors.
If this breakdown saved you from reading 100 pages of footnotes, go ahead and hit that like button. It really helps us out.
And please subscribe and share this deep dive with your investor friends who might be panicking about that profit drop.
And if you want to support us in making more videos just like this one, you can evaluate our membership options.
Or you can show your support directly with super thanks.
Thanks for listening. We'll see you in the next deep dive.